Okay, thank you everybody for joining us this morning. As some of you know, Miller Johnson has formed a cross-functional team to deliver timely and pragmatic resources to our clients and other community members in relation to the pandemic COVID-19 outbreak and its impact on our local and national and international economy and clients. We believe we can best mitigate the fallout from this crisis by working together with clients, government, community organizations, and other professionals. We practice and live in a community that prizes collaboration, intellect, loyalty, candor, and ingenuity. These are our daily guiding principles as we navigate these uncharted waters together. Before we proceed to the substance of today's program, let us take a moment to think about the thousands of people already impacted by this disease, the many more who will be affected, and the dedication of the healthcare professionals, pharmacists, grocers, and so many others who are bracing to help our communities weather the storm. While we cannot stop what may ultimately come, we can adopt a constructive mindset that recognizes our shared sensibilities toward our coworkers, employees, business partners, local economies, and the principles of law. With that said, let's move to today's program, which relates to business agreements and keeping the economy moving forward. Marie Carson will deliver introductory remarks today and provide background on our panelists. Marie.
Thanks, Eric. Good morning, everyone. Thank you again for joining us for the continuation of the discussion of the impacts of COVID-19 in the business community. Today's panelists are Erik Daly, who you just heard from. He's a member in our business section. I'm Marie Carson. You also heard from me yesterday, also a member in the business section. Joining us to speak specifically to real property matters, we have Jim Enns, who's a member in our business section and very experienced in all matters real estate. We also have John Piggins, who's a member in our business section, who does bankruptcy, business continuity planning, restructuring type work. And last but not least, we have Jon Andersh, who is one of our esteemed associates in the business section, and he specializes in real property as well. Before we dive into today's substantive topics, we wanted to take a minute to just overview some of the latest developments in this situation. A lot of this list is likely outdated and will be rapidly changing, but just to frame the conversation, let's all keep in mind that it has now been confirmed in all 50 states, and the death toll in the United States has exceeded 100 people. We know that things in Europe are escalating and they've shut down their borders in increased efforts. We also know that there's a stimulus package proposed at the federal level, which will be interesting to watch the development over the days that come. One additional update from a more localized, unique perspective is we have Orange County in California passing a new ordinance which greatly restricts the movement of its citizens except for those doing essential services. Whether that's a trend we'll see continuing across the country, it's a little too early to tell, but definitely worth considering. And last but not least, we have the coronavirus bill, which I think Erik Daly will give us a little bit more of an update as to what we can expect and how our group is getting prepared and geared up to help our clients navigate that. Erik?
Thank you, Marie. Yes, without diving into the substance of that proposed legislation at this point, I want to assure clients and others who may be listening on this call that our tax and employment law colleagues have been working to track the progress of the legislation through the House and now into the Senate, as well as messaging coming from the administration. And once there is clarity and certainty around what the final details of that legislation include, please know that our team will be moving quickly to update clients on their new obligations, new resources that may be at their disposal to help weather this storm. So I would expect that in the next day or two, we'll probably have more definitive releases on that. And I know that that team is planning to do a webinar later this week where they will go through that in more detail. Thank you, Anne-Marie.
And one final note before we dive into today's program, given the current circumstances, our panelists are all in different locations. So we're going to do our best not to talk over each other, but just wanted to give everyone a little bit of the context of how we're going to make this work as we progress through the conversation. So if you're tuned in by computer, you see the agenda on your screen. Given the urgency or relevance of questions in certain areas, we're going to tweak the order just a little bit. We've gone through our introductions and updates, and we're going to first move into real estate issues, and we'll follow that up with financial modeling. So you'll just see a slight switch around in some of the topics so we can address them in the order by which we're getting questions and seeing some urgency coming from. So with that, I'll turn it over to Jim Enns to start leading off the discussion on real estate issues. Jim?
Good morning. Thank you, Anne-Marie. And by the way, if you'd had me as a coach or as a dad, the notion that I won't talk over each other, anybody else, would be a surprise. So I'm going to do my best in that regard. The overriding thing I want to say about COVID and its effect on real estate, and particularly, with respect to keeping economic activity moving, is that among the real estate attorneys here at Miller Johnson, we really have not seen too much of a detrimental effect of COVID. Transactions are proceeding by and large, with a couple exceptions. They are being slowed down, but not because of the parties necessarily, but because of due diligence delays. And people are working together better than they might normally work together, which is kind of takes the necessity of lawyers as babysitters out of the equation. So it's good, and I say that because outside of business people, we are tending to catastrophize COVID-19, and we don't need to because it's serious enough as it is, but we don't need to catastrophize it. And so things are running smoothly by and large in the real estate business. The overriding thing that I want to talk about is notice, communication. Because most of the questions we've been getting concern either what we call premises liability in Michigan law, or force majeure, which is a concept that most people ignored for really as long as I've been doing this, and that's 37 years. And also the third concept is, or series of questions, is business interruption insurance. And all of those, really, if anyone were going to rely on those as some sort of excuse or rationale for non-performance or for hiccups, all of those require notice and good communication between the parties. And so I want to take first, if I can, this notion of premises liability. Obviously, every business is operated out of real estate. Real estate is essential to every commercial enterprise. And the rules that are in place vary a little bit depending on the type of real estate, whether it's commercial office or retail or entertainment. But in each case, there's a notion that whoever is in control of that real estate has an obligation to the people who come and use the real estate, who visit the real estate, who work in the real estate, who are customers at the real estate. There's an obligation to make sure that the place, the space, is safe. And obviously with COVID-19 and the threat of contamination of the space, there are some risks. And so what people ought to be doing at this point, and you've probably seen it in whatever building you work in, it's important, you would think you wouldn't have to post notices or warnings, but it's important to continue to post notices and warnings, and even to undertake extraordinary cleaning efforts after hours. Jon Andersh, one of my colleagues, is on this webinar, and he and several of the attorneys he works with have, I think, answered questions regarding that extraordinary cleaning and who ought to be responsible for that. Jon, do you want to address that?
Yeah, thank you, Jim. In terms of cleaning in sort of the janitorial maintenance, it is one of those things that is often touched on in leases and real estate agreements, and might not necessarily contemplate heightened measures due to COVID-19. And it is important to go back and look at those agreements, especially in terms of understanding which party bears sort of the general janitorial and cleaning obligations under something like a lease. And then working and having constant communication between a landlord and a tenant, especially in terms of what steps they're taking, maybe what expectations are, and what the plan is for allocation of costs between the two. Because in terms of a lease, those items might not be spelled out in black and white. And in terms of allocating responsibility, it is one of those things that it is going to require constant communication, especially as the landscape changes. With that, Jim, I'll pass it back to you.
Yeah, so thank you, Jon. So one last thing on premises liability, then I just want to speak briefly about force majeure and business interruption insurance. But, obviously the extreme case of premises liability are the cruise ship lawsuits that are starting to be filed. And none of us is operating a cruise ship, and we all kind of shudder at the stories that we read about close quarters and spread of viruses there. But the whole idea of the people that are suing for premises liability are basically, their claim is that the companies are deliberately, ignoring critical information or information available to the owner or the user of the premises that's available regarding preventing the spread of the coronavirus. So whether you're successfully preventing the spread or not, it's important that you're taking the efforts, undertaking the efforts to prevent the spread of the coronavirus so as to ignore to avoid premises liability claims in the future. Force majeure. Force majeure is a notion in the law that says if there are things out of my control, what we used to call acts of God, if there are things out of my control and are third-party induced, we typically in Michigan think of weather situations and extreme weather situations as affecting construction schedules. But if in any instance where there is something that's out of my control and it is affecting my ability to perform, then there is a notion that I can be excused from having to undertake that performance in a timely fashion. Most leases have force majeure provisions, and we're getting a lot of questions about those. But I will tell you that almost every force majeure provision in a lease says, yes, you are excused from performing certain obligations if these situations arise. However, under no instance will force majeure be used to as a defense to paying any rent. So that in Michigan, unless your contract provision, your lease provision provides otherwise, your force majeure will excuse your non-monetary defaults, things like, not operating during the hours you're supposed to operate, things like not being fully staffed if you're a retail establishment that's under co-tenancy provisions. So those non-monetary breaches might be excused, but a monetary breach, the failure to pay rent, will not be excused under force majeure. Last thing I want to cover is business interruption insurance, and as I understand it, we've had several prior webinars that have discussed business interruption insurance, but we're getting some calls on that. And it's hard to give advice on business interruption insurance in the sense that it is dependent on the written terms of the insurance contract, and they vary widely. However, with respect to real estate matters, almost all the time, business interruption coverage is not available unless there is a direct physical loss. So a voluntary shutdown of your business, of your building, of your retail establishment, voluntary shutdown is not going to create the sort of direct physical loss that's necessary to maintain a business interruption insurance claim. Moving away from that, though, there is in many insurance policies coverage for what we call civil and military authority actions, so that if there is a governmental proscription against keeping your building open or your business open, there is some likelihood that the civil and military authority provisions of the insurance contract will cover that loss. I think that's all. Jon Andersh, if you wouldn't mind, this is kind of a non-legal question, but if you wouldn't mind addressing just the sort of communications that landlords and tenants ought to have with respect to tenant employees and their comings and goings, so that a landlord can monitor the threat to its building.
Yeah, thank you, Jim. And it does circle back on the notion of premises liability that you discussed earlier. At this point, it is critical for landlords, tenants, and other occupants of the building to be in, as near constant communication as possible as things are rapidly shifting and changing. And a big part of that is how those landlords, tenants, and businesses are handling their internal policies for responding to and addressing reports of a possible positive COVID-19 test for one of the occupants or one of the employees of the businesses using the real estate. It is imperative that landlords and tenants are sharing that information, their policies, their steps, and the actions that they'll take in response to the possibility or the all likelihood of a positive test. It is one of those things that, while a landlord might not have an affirmative, obligation to disclose a suspected illness, it is a good idea that they're sharing that information with the other people in a building on a case-by-case basis, especially if there's a potential that the affected person has a close contact with a number of people maybe outside of that tenant's company operating within a facility. And as Jim mentioned, ideally, this kind of communication will be made, by a landlord with a tenant, with the involvement and consent of the affected company. And in those communications, it is imperative to note that there are privacy considerations that come into play. Certain names, descriptive information of the affected individual may not and must not be shared in those communications. Things must be general. And it is best practice to make sure that you have permission of all involved before sharing that communication with the right group.
Thank you, Jon. Anne-Marie, that's all that's on our list, although if questions pop up, we'll certainly answer those.
Yeah, so here's a question for you, Jim, or if you want to share the microphone with Jon on the response. I'm a small business. I now, I would say I was food service or some kind of food beverage industry. My hours are now severely restricted. I'm only able to do takeout, carry out. I have severe concerns about my ability to pay rent. If you look at the situation in the news this morning, Long Road Distillers let go of 50 employees. So this is impacting small businesses. What do I do first? Do I reach out to my landlord and start the discussion? Do I pull out my insurance policies and read through them? Do I take a deep breath? Because that's probably the right first step. But what would you say are the critical actions these businesses that are dramatically affected and are worried about paying rent should do?
Fortunately, the first step is not to call a lawyer. The first step is to talk to your landlord immediately. Let him know your situation. If you can share with him financial information, generally, that is loss of sales, loss of activity, share that with him. It's almost like a borrower sharing what he need, everything he knows with his lender. So you have to look at the landlord in that light. So you must notify the landlord of the situation. And if you don't think you can pay rent, let the landlord know that, because there's always ways to work that out. So that's number one. And number two, at that point, after obviously you're weathering the storm, is you might be surprised that you have insurance coverage for that situation, particularly because you're a restaurant, particularly because we have a state order to restrict your operation, for the balance of this week and next week and possibly beyond if that gets extended.
Thank you, Jim. Yeah, that's helpful.
Go ahead, Erik.
This is Erik. Thanks, Anne-Marie. This is Erik speaking. I think if it's okay, we'll pivot now to the financial modeling agenda item in the interest of time. One thing I would observe that is in keeping with the theme from yesterday morning's webinar is in the context of force majeure and similar theories for delaying, excusing, changing the standard of performance under a contract. There's an important distinction between risks that were not foreseeable at the time that the parties entered into the contract for the lease, and those that are foreseeable at the time that a party entered into the contract or the lease. If you are looking to amend a lease or any other kind of contract or enter into a new agreement to supersede a prior agreement to deal with some of the fallout from COVID-19 and coronavirus issues, it's important to keep in mind that this is clearly a foreseeable risk now. So if you are revisiting other contract terms, it may be prudent to look at those other force majeure and similar provisions in your agreement, because as you amend those in retrospect, it may be the case that somebody says and concludes that at the time you amended your agreement that this is now a foreseeable risk and something that could have been addressed. So I just want to leave that maybe as a last thought on that topic, and then pivot over to Jon Piggins to talk about financial modeling. Jon?
Thank you, Erik. First of all, to let everybody on the call know, my background, I come from 38 years practicing law in the business reorganization and bankruptcy law sector. So you're going to get my comments from that point of view. All of the temporary business closures and slowdowns caused by COVID-19 are affecting the income and cash flow of these companies that have to either close or slow down. But they're not only affecting cash flow of those companies, they're affecting cash flow of companies that deal with companies that are now closed or working at a limited capacity. This is going to require a lot of companies to restructure and change the way they currently do business. The companies are going to be forced to request forbearance from landlords, as Jim previously mentioned, and lenders and suppliers, while at the same time asking their customers to wait longer for products, services which can't be delivered as quickly as before. To prepare for this, companies need especially high leveraged companies, need to begin modeling scenarios that are potentially likely here. And when I say potentially likely, I mean an impact of a drop in revenues of 10%, 20%, or even more over the next 6 months to a year. COVID-19 is punching a hole in the economy, and we don't know how long this hole is going to last. It might last 6 weeks, it might last 10 weeks, it might last longer. So business owners are prudent, whether they're highly leveraged or not, prepare a range of business disruption scenarios and list the specific steps that they will take to reduce the negative impact of those scenarios. Some specific things that you might consider are things that you would consider, that any business should consider in planning for a recession. And this is all about planning. It's all about planning for the future and assuming that using these downturns in revenues, that you can continue to operate and how you're going to continue to operate. This means in your planning, put in ways to reduce overhead significantly, including reducing rental space if that's possible, reducing employee overhead, and getting rid of rarely used equipment or stopping rarely used services, those types of things. The other thing that might be involved in your modeling as far as reducing expenses because your income is down is reducing debt. This is probably the biggest concern and the biggest factor that I see in any company that is experiencing financial difficulties. And this doesn't mean stop incurring new debt. This means paying down current debt as much as possible. And if this means selling valuable assets now in order to use that cash to pay down debt, that is very important, because the less debt you have, if this slowdown continues for a long period of time, the better off you're going to be. And this can be plugged into your modeling and put together with these other factors to get you to a place where you can continue to operate on significantly less income. The third thing that is should be a consideration in your modeling is the fact and the slogan that we've all heard in the past, and that is cash is king. Even if you do not have significant debt to pay down, you should consider liquidating unused assets or underused assets in your model to create cash. You don't know what what your cash needs are going to be. You know that your income is going to be much lower over the next 6 months, 9 months, a year. And if you can liquidate little used assets or unused assets to create cash and have some type of war chest, regardless of what happens, that is very important. And we'll get to the communication part of this piece in a few minutes, but I'll throw it back to Erik for any questions or anything with regard to this modeling. But it's important. I guess the last point I want to make is prepare. Act as if we are in a recession, and you need to make sure that when your income goes down, you will have the wherewithal to weather the storm, because the storm is here. We just don't know how long it's going to last.
Yeah, thank you, Jon. That's helpful. And this is Erik speaking. I wonder if you could comment at all on, companies over the last decade may have put in place, for example, revolving credit facilities that they haven't had to use much. Maybe they haven't had to pay close attention to covenants or financial tests and under those agreements. Could you speak at all or provide some advice perhaps on, what steps clients in that situation who may be thinking, oh, I might have to tap this revolver that we've had in place at some point soon, what should they be kind of looking at to make sure that if they're counting on that, it really will be available for them?
My first reaction to that question is don't count on that at all. First of all, because of the economic downturn and because of your particular company's reduction in revenues, you may no longer be complying with the covenants of that revolving line of credit. So you may not, even if you go to the bank and ask to access it, if you haven't been accessing it, they may look at that and say, well, you're no longer within covenants, so you can no longer access it. The second thing is banks in these situations are credit's going to get a lot tighter. Banks are not going to be willing to renew these lines of credit as easily. They're going to ask for more things. They're going to ask for more collateral. They're going to ask for more guarantees. And it's going to be tougher if these lines of credit are coming to an end to renew these. The third thing, and this goes back to my point about reducing debt, don't count on incurring debt to get yourself through this downturn. Do the best you can to create cash. If that's selling unused assets or little used assets, you're much better off doing that than counting on a line of credit in order to get through this downturn, because if the downturn lasts longer than you think and you fall out of covenants and the bank decides that your line of credit is not the one they want on their books, they can turn on you on a dime, and then you're scrambling to figure out how you're going to replace that line of credit. Right.
And on that point, I guess, about potentially selling assets to generate cash, I think it's important for companies that do have outstanding indebtedness to evaluate what their obligations are with regard to the proceeds from any sale, should they liquidate assets, whether that has to be earmarked for paying down debt or whether they can use that for discretionary purposes. I think that will be an important thing for borrowers to understand as they think ahead about how they are. Or go ahead, John.
I'm sorry. Eric, you're absolutely correct. Before you liquidate assets, you want to know where those proceeds are going. If those assets stand as security for a bank loan or a line of credit that has a balance on it, the proceeds from those assets will necessarily have to be paid to the bank. That's not necessarily a bad thing because you're reducing debt. But you need to know in advance if you expect to get cash out of those assets for other purposes and those assets stand as security for bank loans, then you're not going to get that cash. I'm not suggesting you don't sell the asset if it's underused, because reducing debt is just as important as creating cash, but you need to know in advance where that cash is going to go.
Kind So as clients are building out those cash flow projections and building out different scenarios, I think it's important to kind of revisit, and it may have been some time since some companies have looked at those types of obligations, to understand where proceeds from particularly material dispositions might need to be directed. Jon, you mentioned communications piece. Is that something you'd like to speak to?
Oh, sure. I'm happy to talk to that at this point if that's where we want to go.
Yeah, let's go there.
Okay, so once you have created this model, it's very important that you communicate the model, particularly your plan to weather the storm, with all of your stakeholders. That includes lenders, that includes suppliers, that includes customers. This is much more likely to earn cooperation, extra time, and support from all of your stakeholders if you are open and the lines of communications remain open with regard to your financial situation and the fact that you have a plan to weather the storm and what that plan is. When you communicate, we recommend that you stick just to the facts. Communicate the bad news as well as the good news. If you are planning to sell certain assets, close certain locations, make sure that is in your plan and make sure those things are communicated in advance so that your lenders and your suppliers know that you are planning to do this to put yourself in a better financial position. Then when you go to them and ask for time within which to pay their debts, or explain to customers that it's going to take some extra time to get them the product that they need, they will more understand what your situation is and be more willing to work with you. If you're a profitable company with low risk, of this in this downturn, I would also consider reaching out to your key suppliers, because your key suppliers, you need to know that they are going to be able to continue to supply you with the goods and services that you need, and that you don't have to go scrambling and looking for someone else to provide those services or goods. So I would reach out to your key suppliers and work with them, if they haven't done any modeling, to model, learn what they expect from this downturn and whether they expect the downturn will impact your supplies going forward. Again, I think it's very important, the more communication you can have with your lenders, your landlords, your suppliers, everyone, all of the stakeholders and the shareholders, is very important with regard to the model that you've put together and how you intend to weather this storm. Again, we don't know how long this is going to last. You could put together more than one model. One scenario is not as bad as another, and share that with the people that you're going to need to work with in case you're going to need more time or need some cooperation from some of these stakeholders.
Right. I totally agree, Jon, and that was actually going to be my next question. How proactive should businesses be about reaching out to key partners? And you answered it. Maybe one last question before we pivot to some other topics. If in having those discussions with business partners or your own self-evaluation, you come to a difficult conclusion that it looks like either a business partner or your own business is going to face a liquidity crisis that maybe can't be overcome. When do you start thinking about bankruptcy, or trying to get the benefit of an automatic stay in a bankruptcy proceeding? And given this is changing every day with courts, availability to deal with civil cases in particular, is there any preliminary thoughts or advice you could kind of offer on that front?
Sure, Eric. I think in my experience, most businesses don't come to even thinking about bankruptcy until it's too late. I receive calls from potential debtors all the time that I have to give them the bad news that it's just too late. So the earlier you think about it, the better. And consulting a professional, if you really think that modeling is showing that you're not going to be able to weather the storm, consulting a professional sooner rather than later is the best. If there are ways to avoid bankruptcy, you want to try to do that, but you can't do that until you have talked to a professional about the bankruptcy option early on so that you know when is the appropriate time to consider filing. So I would say consider it early, but it should be a last option at the end of the day.
Right. Thanks, John. Yeah, it falls into that category of conducting business in the shadow of bankruptcy, as some like to say, and just making sure you understand the shadow that option casts over how you're conducting business. Anything else, Don?
I would also say in the bankruptcy context, one more comment. If in fact you are attempting to get concessions from lenders and suppliers and customers, often, especially for lenders and suppliers to whom you owe money, if they know that you might be considering bankruptcy or that bankruptcy is something that you have looked at, that might encourage them to give you more leeway than they otherwise would, because they do not want to get involved in a bankruptcy case if they can avoid it. And a lot of lenders and suppliers will work with you on some type of even if it's not an informal forbearance, but a formal forbearance agreement to give you some more time so that bankruptcy does not have to be chosen.
Yes. Thank you, John. Any other observations from our Miller Johnson team members or questions before we move away from this topic?
None here.
Okay. Thanks, Jim. Next, we're going to go through, in the remaining 15 or so minutes we have, we will go through some topics that are relevant to transactional work generally. Anne Marie and I come from a background of mostly private company mergers and acquisitions, so that's our frame of reference for looking at these issues. But I think Jim, John, and John will all have thoughts on these topics as well in their respective areas. The first one, I think, is a very pragmatic issue, and this relates to timing considerations and delays as we're thinking about planning for transactions, scoping timeframes, and workflow. I think it's essential that we all build in more time to get transactions completed, whether that's an M&A deal or a real estate transaction. Depending on the circumstances, workflow is going to be significantly slower than normal as people are obviously working remotely. They may be dealing with family members or other people in their lives who need care or attention, or in some cases, productivity declining just because of distraction from the constant whirl of news and change related to coronavirus and COVID-19. in addition to that, if a transaction requires any kind of regulatory approval or clearance, I think it is incumbent upon the project manager or the other person leading the transaction to plan for meaningful delays. It's unclear how feasible it will be for government agencies to do and perform even some of the most basic tasks that we take for granted, let alone work on more complicated aspects of transactions remotely. For example, antitrust review. In an extreme case, a CFIUS, a Committee on Foreign Investment in the United States type review. We need to plan on those types of delays and understand that some government agencies are going to, in all likelihood, need to prioritize and redirect staff toward other issues that are either directly or indirectly related to the exigencies of dealing with the social impacts of coronavirus. I think the same likely goes for many non-governmental third-party consents and approvals. So as you're planning out timelines for transactions, it would be prudent to build in significant extra time, even if you're not aware of exactly where those delays may come from. Jim, on the real estate side, I know so far things have been, as you put it before, people are communicating on lease terms and continuing to work with one another. If you're planning for a real estate closing or a new project, is there anything specific on the real estate side that you would mention for clients to consider as they're scoping out timing?
Yeah, for what it's worth, we are currently advising that due diligence periods be extended. There was a question that popped up on the screen from an anonymous attendee, kind of related to that, who asked, "Boy, if I don't have a force majeure provision in my contract, and I'm bumping up against timing because of availability, presumably of consultants, can I make an argument that the non-performance is somehow excused?" And so even without force majeure provisions, there are the common law doctrines of impossibility, frustration, impracticability, by which if there's an unforeseen condition, unforeseen by both parties, and certainly this virus and the pandemic, I think, qualifies for that. But if there's an unforeseen circumstance, you can at least make a claim. The problem with that is, in order to make a claim, at that point you're in a fight, you're in the arena, and it's costing you money you don't want to have to spend. So moving forward, easy to say, moving forward, in order to prevent having to be in the arena and spending money on boxing gloves, we're really advising give yourself extra time in the contract.
Right, and Jim, you mentioned due diligence. I think that it's a good segue to another topic that we plan to speak to today. Anne Marie is planning to say a few words about how due diligence may changing, maybe become an even sense of exercise than it has in commercial and M&A transactions in the past. Marie, can you please address that, please?
Thanks, Erik. So I think, what we're beginning to hear is a lot of recurring topics that touch on each of these main points. So in the world of due diligence, we're being impacted by the timing considerations and delays. If transactions are being put off or set on a different timeline, one, that's going to affect the type of diligence that needs to be conducted, and two, that's going to influence what resources folks have to trying to answer the due diligence questions. I think the conversation Jim just brought up of how time plays into all of this is a critical aspect of thinking through how are we going to diligence transactions are there activities that used to be conducted in person and that we're no longer going to be able to do in that way? What, and looking to the future, I think we can all begin raising questions around how is technology available for each industry. And I think we're going to see a variety of new diligence areas that we haven't considered in the past. One, because this is the first global pandemic a lot of us have experienced, and it's impacting industries across the board. And two, because we're all experiencing a new revelation of technology and how it impacts our work life. So I think the terrain of due diligence is going to be rapidly shifting and evolving. I think the pace is going to slow down. I think the types of questions folks are asking are going to change, and it's going to be interesting to see over the coming months what transactions proceed on some semblance of the expected timeline, what transactions slow down, and which ones are put off until there's a different level of stability. And I think, I'd be curious, Jon, if you have any thoughts about real property due diligence or anything that you've seen on transactions you've been working on. Jon Andersh, that is.
Thank you, Anne-Marie. I think it is something that, as vendors, especially in the real estate realm, surveyors, environmental consultants, as those fields move to working, telecommuting and working remotely, there will be delays in terms of getting professionals on site at the property and getting those documents and due diligence reports produced. It is one of those things that, as Jim mentioned, it's critical at this point to plan for those delays in a transaction timeline and to build in extended due diligence periods and the possibility for extension, especially as those industries and those due diligence supporting industries start to slow down. Jim, do you have anything to add there?
I don't. I don't. Other than to say it's not that it's slowing down because there's too much work to do. It's just slowing down because people aren't in the offices, and so logistically there are issues.
And Jon, I'm going to follow up. We just got a question on the Q of A that's not expressly tied to due diligence, but ties into one of the areas I know we've had a little bit of back and forth on, which is there are certain documents, and I love to think of real property as this archaic world where you all love wet ink signatures. So do we see any shifts around that? I know one of the things you had brought up earlier this week was the e-recording capabilities for Register of Deeds. So what are we going to see real property modernize itself and accept more electronic signatures, or do we have any sense of how the requirement for wet ink signatures might shift in the current climate?
Thanks, Anne-Marie. At this point, certain counties in Michigan on a county-by-county basis do have the possibility of e-recording documents. Those documents can be signed wet ink in person, and then the scan or PDF can then actually be recorded digitally with the Register of Deeds. Unfortunately, not all counties in Michigan accept digital or e-recorded documents. It is one of those things that it is a matter of infrastructure. Some counties don't have those systems in place and have not adopted that technology as rapidly as others. We're currently working on a transaction where the title company alerted us that Kent County has, stressed that they are accepting e-recorded documents and will continue to do so. But unfortunately, a couple of counties over, Ionia County does not have that infrastructure in place, and e-recording is not an option. It is one of those things that as government offices start to slow down, close, and have limited staff, recording real estate deeds, conveyance documents, and mortgages that require original wet ink signatures may also cause delays in transactions and in closings. Jim, do you have anything to add on that?
I have nothing to add. I concur.
Perfect. Well, thank you both for your input on that. Erik, I'm not sure if there's something you want to tack on to the due diligence discussion, or if you want to go ahead and move into, we've touched on operating covenants and flexibility, but we could also move to material.
Yeah. Oh, sorry to cut you off, Anne Marie. Thank you. I will tack on one last thought on that, which is, for better or worse, in certain due diligence exercises, historically, there's been a sort of checklist mentality about items or information that needs to be obtained, and that's good. I think checklists do help get work done and create a workflow and a plan. But in extraordinary times like this, it is critical that we build on that foundation and not view due diligence as merely a checklist, but a collaborative exercise that we undertake with our clients, their other advisors, and their other professionals. Yeah, to use the metaphor of everybody grabbing one part of an elephant, somebody the trunk, somebody the tail, somebody the leg. We're not going to see the whole picture unless we open up those discussions, which should be an aspirational best practice anyway in our due diligence, but more so now than ever, to make sure that we're keeping one another informed of the uncertainties and risks that we see as we're going about due diligence and asking the right questions. Moving on to operational covenants and flexibility, I won't spend a lot of time on this. We've got about 5 minutes left in our webinar, and we can go a little over. I do want to leave time for a couple questions. The main thing I want to say here is that when we're under contract or a client is under contract to sell or buy a business, there are performance standards and requirements that between signing and closing, if there is a period of time between signing and closing, that the business operate itself in the quote unquote ordinary course of business. The last few weeks, the coming weeks and months are not going to be ordinary course of business by any measure or any interpretation of that term. So to the extent that you have the opportunity to build in more flexibility for that standard, if you are entering into new agreements that may impose some operating covenants that reference some past historical standard of conduct, I think it's important to build in the flexibility for businesses to respond rapidly to exigent circumstances that may not be ordinary course, that may be required to comply with law, or really just to make sound, reasonable judgments for the health and safety of their employees, their customers, and community at large. So some of these provisions that may in the past have seemed innocuous or standard, and they have been in many cases, may take on new importance as the ordinary course of business changes to something extraordinary in the coming weeks and months. And finally, just a brief word, this last topic that we're going to touch on, material adverse changes and material adverse effects, is fairly specific to the M&A world. But if you're looking at an M&A transaction, or if you're under contract for an M&A deal, looking at how coronavirus or pandemics have been or not been addressed in your agreements, as a closing condition, as a standard for breach, is an important consideration that could impact closing certainty and disclosure obligations. And I would just encourage, if you are negotiating a purchase or sale transaction, to make sure that you have that discussion with your counsel and with the other party about who is bearing the risk should there be a major negative impact on the business, even beyond what other similarly situated businesses are experiencing as a result of COVID-19. And I think our only remaining topic was insurance considerations, which we've touched on periodically throughout. One just final remark on that point. We're going to see more exclusions from insurance coverage related to coronavirus and pandemic-related issues. We've gotten alerts from our insurance brokerage colleagues and carriers to that effect. In the M&A context, it's going to impact the transaction rep and warranty insurance market that's evolved over the last 5 years or so in the U.S. And parties are going to need to think more carefully and get back to a pre-rep and warranty insurance type mindset about how they allocate those uncertainties as between them and the absence of coverage under a rep and warranty insurance policy. So those are the final remarks I wanted to make. Anne-Marie, Jon, Jim, Jon Andersh, any other parting remarks you'd like to make before we take a look to see if there are any questions queued up that we might be able to address?
I do not have any.
Nothing from me, Erik. Thank you.
This is John Piggins. The only closing remark I would make is with regard to the modeling aspect, just work with your accountant and plan. Planning is so important in this environment, and plan for the downturn. And if you plan, then you're going to be in a much better position if the downturn actually gets significantly worse.
Okay, thank you, Jon. And looking at the online questions, I see we have an observation about a real estate transaction, which unfortunately did not close earlier this week. I suspect we'll see some more delays along those lines. Other than saying it's unfortunate, I don't have a response to that note at this time. The other two questions that we have lined up relate to exempt and non-exempt employee issues and employees taking unemployment or sick leave, and how that might affect businesses. And I personally want to defer on those questions just because that area in particular is such a fluid situation and one that is being actively addressed by, hopefully will have been actively addressed by both federal and state governments and agencies. Unless anybody else on the call wants to venture advice on those topics, I would like to suggest that that you can follow up with any of us if you want to have a discussion with an employment law attorney who has some more informed predictions on where that legislation is headed. They, as I mentioned at the outset of the call, they are staying up to date minute by minute almost about the twists and turns that this legislation is taking, and I'm sure would be very interested in talking to people who are facing questions about that and helping them work through it.
Very good.
All right. Well, with that, we are a little bit over time, and we will be reconvening our live webinars every morning this week at 8 a.m. Eastern Time. We may have a different group tomorrow. I appreciate you joining us, speaking on behalf of the panel. Thank you for taking the time to spend an hour with us this morning. We wish everybody the best of health and the best of prosperity as you continue to work through the issues that are challenging your businesses. And encourage you to reach out to us if there's anything you want to follow up about following today's presentation. Thank you.